I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a man who wrote a book just about 2.5, 3 years ago. It was called the Coming Bond Market Collapse. And last Friday, we had a big sell-off, which was largely, a lot of people say it was caused by the bond market and the shaky bond market. I'm talking about Michael Pento of Pento Portfolio Strategies. The website is pentoport.com. Michael Pento, thanks for joining us today on USAWatchdog.com.
I'm really looking forward to this interview, and thank you so much for having me back on, Greg.
Back when you did this book, and it wasn't that long ago, a few years ago, there were no real negative interest rates. And now there are negative interest rates. What's going on in the bond market? How close are we to this coming bond market collapse?
I finished the book around 2012, the end of 2012, and back then the United States was about halfway through its money printing scheme, $3.7 trillion worth. And really the ECB, the European Central Bank, and the Bank of Japan, BOJ, really never even started yet. But as it turns out today, global central bank balance sheets have risen from $6 trillion in 2007 to $21 trillion today. That's the increase in the size of central bank balance sheets. And that's how I knew. And I knew back then, I didn't really believe that rates would become negative. I didn't really understand or grasp the idea that corporate debt could be issued with a negative yield. Those are Twilight Zone things to think about. But I kind of knew we were in a bond bubble, and I could prove to you that when this bubble breaks, it's going to be disastrous. And September the 8th, I'm going to use that date as my point of proof. People wonder why we sold off 400 points on September the 9th. And the reason for that is, and we're down today as this interview is being recorded, down about 250 points on the Dow, and yields are spiking across the globe. The reason for that is because Mario Draghi came out after his September 8th meeting, and he didn't say that he was going to extend or expand quantitative easing. He didn't say he was going to sell his assets. He didn't even say he was going to stop buying his 80 billion euros per month worth of assets. All he did was not promise to expand or extend QE. And that sent the yield on the 10-year from 1.52% to 1.68% in one day. And yields in Germany, they spiked. Bond prices crash, yields spike. And yields in Japan, they spiked as their bonds crashed. And that wasn't because, again, not because central banks created inflation. They reached their targets, and now we're going to begin unwinding their $21 trillion of selling, pent-up selling that has to come if they're ever going to fight inflation. Just that they didn't hint at expanding QE, and look what it has rendered us. That's proof positive, Greg, that everything that's happened since 2008 collapse has just been artificial and ephemeral in nature. And once central banks even hint at pulling back from their QE programs and ZERP and NERP go away, bonds will crash. And when that sovereign bond crashes on a global basis, it's going to take everything else down with it concurrently.
I've told people this, and I'm not an expert like you. I just think that people are going to be shocked at how fast this will get terrible. Tell me how fast this can go wrong.
Well, I'll tell you, on the 21st of September, okay, so that's, I believe that's next Wednesday, I believe.
Yeah.
21st of September. We have two meetings. We have the Federal Reserve meeting, and we have the Bank of Japan meeting. And if Mr. Kuroda comes out and appears as hawkish, quote unquote hawkish, if you can believe, hawkish being not extending or expanding QE, and or if the Fed were to actually raise rates in their September meeting, I think what you saw last week and what you're experiencing this week is just the warm-up act. You're going to have a wipeout in bonds. Don't forget, a lot of these bonds are purchased on repo. So you bring your collateral and you get 90 cents on the dollar. You can buy more of these bonds on leverage. Everybody's going to be rushing for the door at once. And there is no room for maybe 1 out of 1,000 of these individuals to get through. So it's going to be catastrophic. And I want to say this, and I don't use hyperbole. You know, you asked me once, I think our last interview, where gold was going to be at the end of the year. I think I said 1,400. I mean, I'm not here to, I don't use hyperbole. I don't say it's going to 10,000 tomorrow. I don't want to say the market's going to collapse tomorrow because I'm trying to get viewers. And I know that's not how you act either. You know, I will tell you this, and it saddens me to say this because I love this country. What's going to happen eventually, what you're going to see, what you saw last week and what you might see the 21st, that's just a prelude. What's going to happen is exponentially worse because eventually Mr. Draghi, Mr. Kuroda, and Ms. Yellen are going to have to change their monetary policies. They are going to have to, once inflation is achieved, their 2% inflation target is achieved, they're going to have to begin unwinding their balance sheets. Otherwise, there's no way to drain the money supply. They have to sell assets. Now, all of these front runners, this is what happened last week and it's happening today, front runners that are front running the bids from central bankers have to get out. But if you look at, for instance, the Bank of Japan, the JGBs, Japanese government bonds, there are days when these bonds don't trade unless the Bank of Japan is buying them. There are no bids for a JGB 10-year yielding minus whatever. So yields are going to absolutely spike from, say, minus 5 beeps or one beep, whatever they are now, to at least where inflation is, plus a few extra points for insolvency.
Wait. So you're saying that you could go from a slightly negative rate to 3% bond, boom, just like that.
I'm saying that you can go from minus whatever, minus 3 basis points or 1%, to minus 1 basis point, to 2, 3, or 4% in a matter of days.
Oh man!
And when that happens, now all bond markets are fungible, interchangeable. It's a global bond market. So if I can suddenly get 3% on a JGB, and again, I'm not using hyperbole. I'm just saying that you've got a lot of people that have to run for that exit door that own these bonds on margin. And if I know that bond purchases are going to be attenuated to eventually zero, and then the BOJ might become a seller of that massive hoard. I think they own 50% of the entire bond market.
Oh.
So what am I going to do? I'm going to say to myself, well, I need to get at least a positive, what is all investment based upon? A positive return after taxes and inflation. So if inflation's at 2%, remember I told you that they're going to eventually get to their target. That's when they're going to really stop. That's when the real crisis hits. So bond yields got to go at least to 2%. Plus, by the way, as an aside, the Bank of Japan is insolvent and could never pay back the principal. So you're going to have to add at least a few percentage points there. When I say, and I don't use hyperbole, when I say 2, 3, 4%, I'm being generous. I think it's going to spike dramatically. And as I said, the bond market is global in nature. And if I can get 4% on a JGB and a 1%, 1.5%, 1.7% on a 10-year, I might sell that 10-year and go over there to Japan where I'm starting to get my money's worth. And that's going to cause all yields to spike concurrently in unison. And everything, and I'm talking about Ferraris, diamonds, commodities, real estate investment trusts, municipal bonds, collateralized loan obligations. I mean, everything is priced off of that risk-free rate of return. And that's been taken to 0% for 96 months. And the ECB has now taken, I think it's 30% of the entire investment grade corporate bond market into negative yields. Let me say that again, because this is important. 30%, not Michael Pento's proprietary research, this is Wall Street Journal. 30% of investment grade European corporate debt, trades with a negative yield. In fact, there are some issuances that are trading in the primary market with a negative yield. In other words, corporations, in some cases, because the ECB is buying corporate debt, they're getting paid to issue debt. Hey, why go out and hire employees? Why go out and expand capital goods to create productivity and grow the economy? Your business model can be selling debt to the European Central Bank. So when the bond market collapses, and I suggest everybody get a hold of that book, because it's self-serving, but the book was written in 2012, but it explains exactly, before all this happened, exactly what was going to happen, why it happened, and what's going to happen in its aftermath. You need to know, because everything is going to go down together. If they are going to follow this model of deflation, they're going to allow money supply to shrink, if they're going to stop their repression of interest rates, everything is going to collapse concurrently. And that's why when that happens, I think then you're going to adopt things such as all these happy thoughts, such as the end of cash, a cashless society, charging you interest on holding money in a bank, helicopter money. All these things are going to come on the back end of this. So, boy, oh boy, if you think this was the last few days sent the VIX up to 18 from 12, if you think this was exciting, it ain't nothing, my friend.
This must be what Gunlock and Carl Icahn, Bill Gross, Lord Rothschild. This must be what they're seeing, what you're describing, because they're freaking out. This must be what they're saying. Do you think that's a pretty good bet?
Well, maybe they read my book. I don't really know. I wrote that in 11, and it came out late in 2012. But I kind of agree with them. You think everybody who's hiding in utility stocks, trading at 22 times earnings, this is never heard of before. Never heard of before. Do you think junk bonds yielding 4% are where you want to be? Do you think cap rates on commercial property should be 3%? This is all based on this massive search for yield caused by $21 trillion central bank balance sheets. So I would have preferred that we had our little collapse in 2008 and maybe a year or two of a depression, recession. I guess the stock market would have gone down for 50%, maybe stayed there for a while, and the real estate prices would have collapsed by 30, 35%, and banks would have become insolvent, and yada, yada, and things would have been bad for a while. But guess what? At the end of that time frame of around 2 years, the depression would have ended, and we would have had stable money supply and stable interest rates. We would have had productivity. We would have had GDP at 4% instead of what it is now. By the way, I got to touch on this before I forget. The Fed is going to lose all their credibility on September the 21st. And I'll tell you why. Half of the Fed, there's 10 voting members, half of the Fed is, and this includes Janet Yellen at Jackson Hole, has been telling you that the economy is healed. Now, this is a data-dependent organization. The economy has healed, and they're ready to resume interest rate hikes? Well, GDP is growing at a 1.2% rate year over year. Productivity is down 3 quarters in a row. Earnings on the S&P 500 are down 6 quarters in a row. Look at the ISM August manufacturing data. We're in a recession there. The service sector, which is by far the largest part of the economy, went from 55.5 to 51.4. Absolutely crashing in the ISM service sector. So what data are they looking at? If they're going to raise rates on September 21st, I don't think they do. They are going to be no longer data dependent. They're just freaking out about having promised to save the world and be able to raise rates 4 times in 2016 and just trying to, I don't know, garner some credibility because they can raise rates before the end of the year. But if they don't raise rates, they're going to lose all their credibility anyway, because they've been threatening to do so. But if they do raise rates, they're going to lose credibility because they're not data dependent. They don't know what data they're looking at. I don't know. Maybe they're getting data from another country that I'm not aware of. But the data here in the United States is screaming recession. And I was right. I wrote that book in 2012, and I said ever since the collapse of 2008 that the U.S. economy cannot grow, because you cannot grow an economy without expanding productivity. And that requires the purchase of capital goods. And when companies are getting paid to issue debt to buy back their shares, that is not prescription for productivity and growth.
Is this why Gunlock and even Bill Gross, the bond king, is telling people to buy Lord Rothschild? I mean, these are all gold buyers all of a sudden. George Soros. I mean, these all people are all buying this nasty, bag of dirt relic called gold. Of course, I'm saying that facetiously. I don't believe that. But they're all buying gold all of a sudden. They went from being total paper guys in the bond market to maybe we should buy some gold. Is that why they're buying gold? Because what you're describing?
I gotta tell you this. Once it comes, right now gold has been, the past few days hasn't been doing very well, especially the miners, because the Fed is out there telling you. There was several hawks came out last week. Hey, we're ready to go. I mean, September's a live meeting, and we're ready to go. I say go ahead and do it. I would love that to happen. If that happens, we can finally get that watershed epiphany from central bankers in the United States, that they are no different than Japan, we are no different than Europe, and we're no different than China. When that happens, the dollar crashes, because the Fed is going to have to admit, if they're going to pursue an interest rate hiking cycle and follow those dot plots up to 3-4% on the overnight interbank lending rate, they're going to absolutely crater the stock market. And as I just proved before, growth is anemic at best. And we're probably, if we're not in a recession now, I think we've been in a recession for a while. If you actually look at, if you deflate nominal GDP by a real deflator, a real inflation rate, we've been in a recession for a while. But in either case, I got to tell you this: if they're going to, they will crater the bond market, they will crater the stock market, and I believe gold might suffer for 3 weeks. But they're going to come and pull out their feathers, and they'll all be those of a dove. The FOMC, even Fisher, will come out, Mr. Fisher, Vice Chair, will tell you, hey, listen, we're no different from any other country. We need to look into expanding, going back into QE, expanding helicopter money, blah, 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 everything everybody else is doing. And in that case, the dollar is going to absolutely tank. That's what's going to happen. And when that does occur, then gold's going to be completely unglued from its moorings and shoot up to very close to record highs very quickly. It's not going to happen until the Fed admits that they cannot raise interest rates. Right now, they're still bluffing, and look what it's doing to the global economy, and the global markets are in chaos, and it's just the beginning.
Wow. So you're saying if they come out September 21st and say, the economy's doing good, but we're not going to raise rates, gold's probably going to take a pop, and so is the rest of the market.
Oh, no doubt.
And
I'm sorry.
And you think that the whole dollar, you wrote a piece about how the whole, when the economy gets really tanking, it's going to be bearish for the dollar. It's going to be bad for the dollar, not good for the dollar.
Yeah. Well, in 2008, see, this is another, Wall Street is full of fallacies and these PhDs that have all their models that are broken and should be discarded. But one of the fallacies I hear on Wall Street, one of the mantras is, well, when there's chaos out there, people run to the yen. Now, why would anybody run to the yen? That had me thinking, why, and I did my research, and people don't run to the yen for safety, and they didn't run to the dollar. Think back in 2008, we had a collapsing housing market. Our banks were insolvent, yet people ran to the dollar for safety. It cognitively makes no sense. But what was really happening was an unwind of a carry trade. So the dollar had been falling for all those years going up from 2002 to 2008, and people were borrowing the dollar and investing in higher yielding currencies and more ebullient growth rates in China and Brazil and Russia and India. Well, that's not happening any longer. People have been buying the dollar and shorting the yen and shorting the euro because we have higher yielding rates here than they do in Europe and in Japan. So when the next crisis comes, I think it's going to be an unwind of that carry trade. And that means that you have to sell dollars and buy back the yen and buy back the euro. So I don't think the dollar is going to be going up as much as at all, if at all, as it did circa 2008. But most importantly, the dollar is going to fall because the Central Bank of the United States is going to have to admit that we're no different than the Bank of Japan or the European Central Bank. They're in the throes of their QE programs. I mean, again, they didn't extend or expand the programs. We'll find out more on the 21st from Mr. Kuroda. But they're in the full-blown QE over there. And we're talking about, not only did we end QE, but we're talking about hiking rates. So when our monetary policy becomes more synchronized with the ECB and the BOJ, the dollar is going to get wiped out.
While we're talking about the dollar, Jim Rickards has been out talking about how that we're going to have this yuan SDR bond, the IMF bond in yuan, and it's going to become a more part of the SDR, and it's going to make the dollar take a hit. We didn't have a good G20 meeting. Everybody hates Obama, it seems. I mean, it was a terrible meeting. But what do you think about that prediction that by the end of the month, beginning of October, that the dollar is going to take a pretty big hit, and thus maybe other assets, this U.S. stock market, bond market, will also take a hit by the end of the month? What do you think about that prediction?
Well, listen, the overall trend, we have huge trade deficits here, huge current account deficits. So the trend for the dollar should be weakening. The only thing that's holding it up is this divergent monetary policy. And, before I got kicked off on CNBC, my last interview with Kelly Evans, I told him, I said, the notion that the U.S. economy can have a divergent monetary policy, trenchantly divergent from every other central bank on the planet, was a non-starter. Rates cannot go up here unilaterally. They're going to have to go up in concert concurrently with other central banks. And guess what? Well, they're still talking and threatening about raising rates. And in fact, other than Lael Brainerd yesterday, we had a plethora of hawks come out saying, hey, it's time to go. We need to start raising interest rates. So in that environment, I doubt the dollar is really going to get hit. If the Fed is going to go down the road of a truncated rate hiking cycle, then the dollar is probably going to stay strong. It's going to weaken only after the effects become evident, and that is crumbling bond prices, crumbling stock prices, and crumbling real estate prices. It'll be at that juncture that the dollar gets crushed really hard. Because as you said, with SDR and current account deficits, trade deficits, dollar should be weakening anyway. And the trend overseas is to relegate the dollars and attenuate the dollars, the hegemony of the U.S. dollar. So it's to have it less important in the SDR, have commodity trade agreements that are not done in dollars. So the trend for the dollar is definitely down.
Michael Pento, here's the book. Let me give it to you a full screen. It is the coming bond market collapse. It could have been written this week. It's quite a book. It is on the homepage of Pento-Port.com. Michael Pento, Pento Portfolio Strategies. Lovely interview, my friend. And you getting kicked off the CNBC is a badge of courage. I got kicked off the CNN for saying that all the banks were in trouble and that we were that the thing was going to crash. So, badge of courage, my friend.
God bless you for telling the truth, having that courage. Thank you.
Well, hey, Michael Pento, go to his website, Pento-Port. The book is on the homepage of Pento-Port.com, and you can scroll down and find the book. You can't miss it. Here's what it looks like again. It's the book. I'd love it if you would add a couple of chapters on negative interest rates and reissue the book, but that's for another time. Michael Pento, thanks for joining us today on USAWatchdog.com.
Thank you, Greg.